Introduction to the Intelligent Investor's Mentality. Welcome to this detailed exploration of the Intelligent Investor's Mentality, a mindset that was perfected by one of the greatest investors in history, Benjamin Graham, in his landmark book, The Intelligent Investor. Graham shared his philosophies that continue to shape investment practices today. For Graham, investing was not about speculation, quick trades, or chasing the next hot stock. Rather, it was about applying reason, discipline, and analysis to make smart, calculated decisions. The ideal investor, according to Graham, is one who stays unemotional in the face of market fluctuations, who uses a methodical approach, and who sticks to a strategy grounded in rational analysis. This is what he called value investing, a method focused on buying assets for less than their intrinsic value and holding them for the long term, in contrast to speculation, where investors bet on short-term price movements. Value investing requires an understanding of the true worth of an asset, often grounded in financial statements, market trends, and the long-term outlook of a company or market. In this series, we will break down Graham's mentality, focusing on the key principles that shape an intelligent investor's approach. From psychological discipline to risk management, we'll explore how to develop a mindset that is disciplined, unemotional, and, most importantly, methodical. The core philosophy: value investing and rational decision-making. Graham's core philosophy can be summed up as a belief that successful investing is more about preservation of capital than about seeking high-risk, high-reward opportunities. His approach to investing, called value investing, is grounded in the belief that you should only purchase assets that are undervalued compared to their intrinsic value. Intrinsic value is the actual worth of an asset, calculated by analyzing its fundamentals such as earnings, assets, liabilities, and overall market conditions rather than just its market price. For Graham, investing was a rational process. It involved reason and analysis, not guesswork or emotions. He argued that speculating on price movements in the short term was akin to gambling. Instead, intelligent investors should look for undervalued stocks, bonds, or other assets that are selling for less than their intrinsic value, ensuring a margin of safety. This margin of safety serves as a cushion against market fluctuations, ensuring that even if an asset's price temporarily drops, the investor is protected by the gap between the market price and the intrinsic value. By focusing on undervalued assets, investors minimize the risk of losing capital, while maximizing the potential for long-term growth. Mental discipline: cultivating the right investor mindset, of the most essential aspects of the intelligent investor's mentality is mental discipline. For Graham, successful investing isn't about reacting emotionally to market movements. It's about staying calm, patient, and methodical, regardless of short-term market volatility. Many investors fail because they become emotionally attached to certain assets or get swept up in market trends. They may panic and sell during market downturns or chase high-risk stocks during rallies. To avoid such pitfalls, Graham emphasized the importance of a disciplined, unemotional approach. He argued that successful investing is a long-term game and that the intelligent investor needs to ignore the noise of daily market fluctuations by sticking to a clear, reasoned strategy based on research and analysis. Investors can avoid making knee-jerk reactions to short-term market movements. Mental discipline also involves the ability to tune out market sentiment, which often leads to irrational decision-making. Whether the market is euphoric or in panic mode, the intelligent investor stays focused on their analysis, not the prevailing market mood. The role of risk management in Graham's philosophy: risk is an inevitable part of investing. But according to Graham, managing risk is what separates the intelligent investor from others. Graham didn't believe in eliminating risk entirely. Rather, he believed in understanding and managing it. In Graham's view, risk management is all about knowing what you own and why you own it. The intelligent investor does not speculate on high-risk investments, but focuses on value and safety. The key to Graham's approach is the margin of safety, a principle that ensures an investor doesn't overpay for an asset. By purchasing assets at a significant discount to their intrinsic value, the investor creates a buffer against potential losses if the market turns against them. In addition, Graham advocated for diversification as a way to manage risk. By holding a variety of assets across different sectors and asset classes, investors reduce the risk that one underperforming asset will dramatically impact their portfolio. Diversification is a critical tool for controlling risk while maintaining opportunities for growth. The investor's behavior. The battle between greed and fear investing is not just about numbers and anal. It's also about managing the psychology of the investor. One of the most challenging aspects of investing is the battle between greed and fear, two emotions that can drastically influence decision-making. Graham understood the powerful role of psychology in investing and warned that emotions like greed and fear often led to disastrous investment choices. Greed drives investors to chase after the next big stock or investment opportunity, often without proper research or analysis. It leads to overconfidence, which can result in overconcentration in speculative investments. Conversely, fear leads to panic selling when market conditions turn negative, causing investors to abandon their long-term strategy at the worst possible moment. The intelligent investor must learn to manage these emotions by following a disciplined strategy. This means resisting the temptation to act impulsively during times of market euphoria or fear and sticking to a strategy grounded in analysis, patience, and reason. Asterisk the role of mental discipline in Graham's philosophy. Intelligent mental discipline. Mental discipline is at the core of Benjamin Graham's investment philosophy. For Graham, it was essential to approach investing with a clear, rational mind free from the emotional turmoil that can cloud judgment during market fluctuations. Successful investing is not a sprint, it's a marathon. It requires the ability to stick to a well-defined strategy and remain focused on long-term goals. Graham emphasized that emotions, especially fear and greed, can derail even the most carefully thought-out investment plan. Investors who are driven by greed might buy stocks based on market trends or hype, only to see their investments plummet when the market shifts. Similarly, investors overwhelmed by fear might sell their holdings during downturns, locking in losses, and abandoning their strategy at the wrong time. To counter these emotional impulses, Graham advocated for a methodical approach. The intelligent investor doesn't let short-term market fluctuations dictate their decisions. Instead, they adhere to their strategy, trusting that their value-based approach will succeed over the long term. A disciplined investor focuses on intrinsic value, not the volatility of market prices. Risk management and the margin of safety. The importance of managing risk. One of the cornerstones of Graham's philosophy is managing risk through the margin of safety. He believed that no matter how thorough your analysis, investing inherently involves uncertainty. Therefore, the key to successful investing is protecting yourself from potential losses. The margin of safety is a concept that refers to buying investments at a price lower than their intrinsic value. This cushion minimizes the risk of permanent loss, even if the market price temporarily drops. Essentially, it's the difference between what you're willing to pay for an asset and what it's really worth. By buying undervalued assets, you give yourself a buffer against unforeseen market conditions. Graham also emphasized that risk should be viewed not just as a potential for loss, but as the uncertainty of future returns. A disciplined investor manages risk by diversifying their portfolio and ensuring that no single investment holds too much weight. In this way, a diversified portfolio acts as an additional margin of safety, spreading out exposure and reducing the impact of any single asset's poor performance. The investor's behavior. Battling greed and fear. Psychological side of investing. Graham recognized that the greatest obstacle to successful investing isn't necessarily a lack of knowledge, it's often emotional behavior. The battle between greed and fear often leads investors to make irrational decisions. For example, greed might push an investor to chase speculative stocks or market trends, while fear might cause them to sell out of a position prematurely during market declines. Graham emphasized that intelligent investing is grounded in psychological discipline. The intelligent investor must have the ability to remain unemotional during periods of market volatility. Rather than reacting to market swings, they should adhere to a methodical, value-based approach. For instance, during market booms, investors driven by greed might overpay for stocks, resulting in losses when the market inevitably corrects. On the other hand, during market downturns, investors overwhelmed by fear may panic sell, locking in losses at the worst possible time. The intelligent investor stays calm, sticks to their principles, and focuses on long-term value rather than short-term price movements. Mental discipline is the key to maintaining composure and avoiding costly mistakes. Building a consistent strategy. The power of Patience, role of patience in investing. In the world of investing, patience is a virtue. Graham firmly believed that the intelligent investor's best ally is time. This philosophy is embodied in his famous quote, "The stock market is a device for transferring money from the impatient to the patient. Patience allows an investor to ride out volatility, avoid emotional reactions, and let their investments grow over time." While many investors may be tempted to jump in and out of stocks based on short-term market movements, Graham's philosophy encourages patience, waiting for the right opportunities and allowing investments to mature. Graham's approach was never about chasing high returns or market trends. Instead, it was about consistent, steady growth through undervalued, fundamentally sound investments by focusing on the long term. The intelligent investor is less likely to be swayed by market noise and more likely to achieve consistent, risk-adjusted returns. The defensive investor versus the enterprising investor. Two types of intelligent investors. In The intelligent investor, Graham makes an important distinction between two types of investors, the defensive investor and the enterprising investor. Each approach has its own strategy for building a diversified portfolio, depending on the investor's goals, risk tolerance, and available time for active management. The defensive investor seeks a low-maintenance portfolio that requires minimal time and effort. This investor typically focuses on blue-chip stocks, government bonds, and ETFs or mutual funds. The strategy is to maintain a stable, diversified portfolio that offers reasonable returns with limited risk. The defensive investor is concerned with capital preservation and steady income over aggressive growth. The enterprising investor, on the other hand, is willing to put in more time and effort to actively manage their portfolio. This investor seeks higher returns through more active stock picking, focusing on undervalued or special situation investments. The enterprising investor might be more comfortable with higher risks and will spend more time researching companies, bonds, and market conditions. Both types of investors can succeed using Graham's principles. The key difference is that the defensive investor emphasizes safety and stability, while the enterprising investor takes a more hands-on approach, actively seeking opportunities for growth. Practical steps to becoming an intelligent investor. How to start implementing Graham's principles. Becoming an intelligent investor doesn't happen overnight. It requires a commitment to long-term thinking, discipline, and education. Here are some practical steps to help you begin. Educate yourself. The first step is to learn the fundamentals of investing. Graham's The Intelligent Investor is a great place to start, but you should also familiarize yourself with other value investing resources, financial statements, and industry reports. Define your investment policy. Develop a clear investment policy based on your goals, risk tolerance, and time horizon. Your policy should focus on buying assets that are undervalued based on fundamental analysis. Practice patience. Adopt a long-term mindset and avoid the temptation to act impulsively. Patience allows you to withstand market volatility and reap the rewards of your investments over time. Diversify your portfolio. A key principle in Graham's philosophy is diversification. Spread your investments across different asset classes, sectors, and geographical regions to reduce risk. Avoid speculation. Speculating on short-term market movements is contrary to Graham's principles. Instead, focus on value and intrinsic worth. Make your investment decisions based on careful analysis, not market trends. The dangers of speculation and chasing the market. Speculation versus investment. Graham often distinguished between speculation and investment. Speculation involves buying an asset based on the hope of selling it at a higher price in the short term, often without a thorough understanding of the asset's true value. Investment, according to Graham, is about buying assets for their intrinsic value and holding them for the long term. The danger of speculation is that it leads to emotional decision-making and irrational behaviors. When speculating, investors may buy into stocks, bonds, or other assets simply because of market hype or because they expect others to buy at a higher price. This creates price bubbles, where prices rise far beyond the asset's true value, leading to inevitable crashes. Graham argued that speculative behavior is akin to gambling, as it ignores fundamental analysis and relies solely on short-term price movements. The intelligent investor avoids this trap by focusing on assets that are undervalued based on solid research. Final thoughts on the intelligent investor's mentality: building wealth with patience and discipline. Intelligent investors' mentality is a mindset grounded in discipline, patience, and rational decision-making. It requires the ability to stay calm during periods of market volatility and to follow a well-defined, value-based strategy by focusing on long-term goals and maintaining a margin of safety. Intelligent investors can achieve consistent returns while minimizing risk. Adopting Graham's principles isn't about trying to outsmart the market. It's about following a proven strategy that has stood the test of time. The intelligent investor focuses on value, intrinsic worth, and methodical analysis rather than speculation, emotion, or short-term trends. In conclusion, becoming an intelligent investor is a journey of education, self-discipline, and long-term commitment. By following Graham's principles and maintaining a disciplined approach, investors can build a resilient portfolio that stands the test of time and achieves consistent, risk-adjusted returns. Thank you so much for joining me on this in-depth exploration of the intelligent investor's mentality. I hope this series has given you valuable insights into Benjamin Graham's time-tested investing principles. Whether you're just starting out or are a seasoned investor, his focus on discipline, patience, and methodical analysis provides a solid foundation for building long-term wealth. Remember, investing isn't about following the latest trends or chasing quick gains. It's about making informed decisions, managing risk, and having the mental discipline to stay the course, especially when the market gets volatile. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you don't miss any future content. Feel free to drop your thoughts or any questions in the comments below. I'd love to hear from you and continue the conversation. Until next time, stay disciplined, stay patient, and keep investing smartly.